Welcome to the Motley Fool's Bottom Line series. In this video, we're breaking down negative interest rates and why they're seemingly popping up in major economies across the globe. First off, let's talk about what a negative interest rate is. With standard behavior and normal interest rates, if you put money in the bank in a savings account, the bank pays you a small fee or interest for making that money available to them. Negative interest rates work in the opposite way. With a negative interest rate, you'd have to pay a bank to keep money in a savings account. But if you borrow money from the bank at a negative interest rate, let's say to buy a house, you would actually end up paying back less than you borrowed to buy the home. It seems crazy because it's so different than what we're used to, and negative interest rates were unheard of prior to 2012. But currently, they make up roughly 45% of all non-U.S. bonds around the world. In some countries, negative interest rates have trickled down to corporate bonds and even consumer debts like mortgages. Even some US-based companies, including Apple and Microsoft, have issued foreign-denominated bonds with negative yields. So why exactly do negative interest rates happen? Just like when interest rates are lowered in the US, negative interest rates are a form of economic stimulus. Generally speaking, the lower interest rates are, the easier it is for money to flow through an economy. Negative interest rates penalize banks for keeping too much money in reserves in central banks and encourage them to make loans. They also encourage consumers to borrow money. After all, if you could get a $20,000 loan and have to pay back just $19,000, doesn't that sound tempting? So what do negative rates mean to consumers and the economy? On the surface, negative interest rates may sound like a good thing, at least for consumers. Imagine being able to buy a home and the bank pays you interest each month. But negative interest rates can be a big sign of economic trouble. Usually central banks and organizations only resort to this kind of thing if they desperately need to stimulate the economy. Negative interest rates can also produce high inflation, as cash today would literally be worth more than cash tomorrow. With negative interest rates showing up in economies like Germany, a lot of people are wondering, could negative interest rates happen in the US? To be clear, even after the recent collapse in bond yields, the US is a long way from negative interest rates.
Right now, the 10-year Treasury yield is at about 1.8%, and the 30-year Treasury yield is around 2.3%.
Consumer interest rates like mortgages, although at historic lows, are also well into positive territory. But negative interest rates in the US are certainly possible. The trade war between the US and China has created recession fears, and if President Trump had his way, the Federal Reserve would dramatically cut the federal funds rate now. If the US enters a full-blown recession and interest rates are already low, it's entirely possible that negative interest rates could be a form of stimulus that is used to boost the economy. But it's the kind of thing that won't happen overnight. There would be plenty of other movements along the way to signal financial distress. With where interest rates are now, they still have a decent amount of room to be lowered to provide the easy money that can help revive a struggling economy. Thanks for watching this video. Do you think the US is headed toward negative interest rates? Let us know in the comments below. And if you like this video, be sure to press the thumbs up button and click subscribe. It helps us reach more people, which allows us to make more awesome content.